talking about trading through periods of drawdown when trading automated strategies. I have selected here our FX Euro Razor system using 8 years of data, and I'm going to generate a trade report using the TradeStation trade data from the XML files. As this report is generated, I'll drop down to the equity curve graph, and you'll see that it's a fairly smooth equity curve with consistent results. Looking at the report here, you'll see that slippage and commissions of $30 per trade has been added here. And you look at some of these numbers, you'd see that this is a single system that I think anyone would like to have for their portfolio. But let's take a look at what would happen if we set a custom date range using only 2 years of data from 4/6 of '09 to 4/8 of 2011 and generate the same report from the same data, but only over a shorter period of time. Now, as this report is generated, we might expect to see the equity curve graph look slightly different. And here it looks a little choppier. And these periods between these green dots are known as drawdown. And so any trader trading automated systems must endure these. Actually, any type of trader must endure drawdown. And that is why it is so important to have your leverage set correctly. I risk no more than 2 to 3% of my total equity per trade so that I don't blow my account up when trading through these periods of drawdown. So this is just an important thing to see so that you can understand when you're trading these systems that drawdown will occur. Now, if I were to look at drawdown analysis, you'll see a window here that shows what this drawdown, how significant this drawdown is. So in a walk through time, every time this red goes up towards this zero line, that means that's when the equity curve is setting a new peak. And so each one of these would be a new equity peak. And you'll see you spend quite a bit of time in this area, which is for a full lot on FX Euro Razor up to $3,200 or $3,600. And so you will have to endure the equity both rising and falling as you move forward through time. And this is an important thing to realize when trading these auto systems. One of the ways that I look at doing or trading auto systems is I look at a max drawdown over a portfolio of systems, and I'll just take that as an assumed cost of trading this system. So I may look at this and say $4,000 is what my risk is for trading this series of systems. And as long as, like, if I start with $20,000 on this account, and I assume anything over $16,000 is good, and it's where I should be. Then I'll let this thing trade, and then as it moves up, I won't get too excited about it. But if I start with $20,000 and then realize that I've lost some money and gone to 16,800, many people think that the system isn't working. It really is. You just have to be able to withstand this period of drawdown. And so that's one of the things that I wanted to point out when trading any type of automated strategy is these periods of drawdown are inevitable and will occur. You can count on it. And you just have to be able to understand how to use your leverage correctly so you can make it through those periods so that you can realize these new equity highs as they occur periodically through time. This is Alan Mooring signing out.